Canada just shook the table. Ontario and Alberta issued massive foreign bonds, completely locking out U.S. banks. Ontario's $2 billion deal led by Barclays and Canadian banks marks the first U.S. free bond since 2011. This isn't just finance, it's a geopolitical statement. With U.S. tariffs squeezing Canada's steel and auto sectors, the response is clear: pivot away from Wall Street. Is this the beginning of a new financial era in North America? Let's break it down. Tariffs rattle Canada's financial engine. What started as a tit-for-tat over tariffs is now jolting the financial wiring of the continent. In June 2025, Ontario issued a $2 billion Yankee bond, its first without a single U.S. bank since 2011. Instead, the province turned to Barclays and a squad of Canadian institutions like CIBC and Scotiabank. Was this just about getting the best rates? Hardly. This was a calculated move. Ontario's answer to Trump's tariffs on steel, tech, and automotive components. Doug Ford's administration had already taken a swing by deprioritizing U.S. firms in public contracts. Now they're targeting the money pipeline. For context, Ontario is home to Ford, GM, and Honda plants. So when the province flexes its financial muscle, the automotive sector listens. By sidelining U.S. banks, Ontario is signaling it's done playing ball on Trump's spiel. The province expects to borrow $60 billion this year, with nearly a third coming from foreign markets. That's a whole lot of capital now bypassing Wall Street. A fiscal maneuver, it's a geopolitical one. The message: Ontario is shifting gears, steering its financial partnerships away from New York and toward London and Frankfurt, quietly but decisively. But Ontario isn't the only province making this pivot. Alberta's financial strategy is hitting the throttle too. Alberta takes the off-ramp, Europe takes the wheel. Ontario isn't riding solo. Back in March, Alberta made its own power move, floating 1.25 billion euros in bonds without Bank of America, breaking a... So after a 6-year streak, Barclays, RBC, and TD handled the job. Alberta says U.S. banks weren't banned, but let's be honest, the signal was loud and clear. This wasn't just about bonds. Alberta is steering its oil exports into new territory too. Literally, tanker routes are being recharted toward Asia and the Gulf of Mexico. And guess who's backing the financing? European insurers and bankers. Even pension fund managers are hopping on this trend. Frankfurt's meeting rooms are now just as likely to host Canadians as Washington's. These days, swaps and hedging strategies are shifting from Manhattan to Mayfair. For Alberta's transport and logistics industry, especially heavy haulers and energy-linked commercial vehicles, this pivot means re-evaluating capital sources, supply contracts, and insurance backing. If you're a trucking operator in Edmonton, your next financing deal might be coming from Frankfurt instead of Philly. Before we delve deeper, do us a favor, smash that like and subscribe button. Now that we've seen how bonds and exports are changing course, let's explore how those same forces are rewriting who wins government contracts. Buying Canadian from steel bolts to server farms. Tariffs haven't just redrawn Canada's debt map, they're reshaping who wins its contracts. Ontario's new procurement rules now favor Canadian and allied vendors over U.S. ones. If you're a software firm in Seattle or a steel supplier in Pittsburgh, good luck cracking those bids unless no local option exists. One hospital, for instance, chose a Swedish software provider over a U.S. competitor, citing currency risk and cost efficiency. That's not just a one-off. Multiply it across thousands of public sector bids, and you've got a shift that touches everything from municipal broadband systems to the bolts in your car's frame. And for automakers, with Canadian steel climbing to the top of the supplier list and U.S. inputs getting pushed down, expect shifts in procurement patterns inside Ontario's factories. Supply chains were already strained. This adds another layer of recalibration. Even British Columbia remains partially aligned with U.S. financial firms, but the broader trend is undeniable. The North American financial gearbox is grinding, and Canada is shifting into a new lane. But the impacts don't stop at procurement. Behind the scenes, Canada's financial architecture is quietly shedding its reliance on the U.S. dollar. Subtle cracks in the dollar's armor. From U.S. banks, quiet fractures in North America's dollar-based system are beginning to hum beneath the surface. In Vancouver, late-night commodity traders are reporting liquidity snags and accessing U.S. dollars. An echo not heard since the 1998 Asian financial crisis. It's not panic, but the warning lights are blinking. Behind the scenes, Canadian financial institutions are now modeling risk not off the Fed's playbook, but off the European Central Bank's yield curve. That's more than just a spreadsheet tweak. We're seeing a real directional shift in who sets the tone for capital strategy. And while cross-border capital flows remain robust, over $1 trillion of Canadian money parked in the U.S., and about $500 billion flowing the other way, many institutions are quietly installing just-in-case hedges. For example, a Boston-based fund recently added a hedge position against prolonged U.S. Canada trade instability without even moving assets. The play here is to stay exposed but brace for turbulence. We're seeing this volatility on the ground too. In Thunder Bay, a solar panel startup saw its market share boom after tariffs hit Chinese imports, only to get burned by copper shipment delays from Shanghai. It's a reminder that in today's supply chain jungle, even local wins are tied to global bottlenecks. These ripple effects are especially visible in Ontario's auto industry, where financing decisions are now steering the future of car production itself. Ontario's auto sector steers into the unknown. At the eye of this financial cyclone sits Ontario's automotive heartland. It's the province where Trump's tariffs landed their hardest punches. And now, ironically, it's where Canada's financial counterpunch is landing with precision. Ford, GM, and Honda run massive production centers in Ontario. For them, every change in bond pricing, foreign capital access, or procurement policy isn't abstract. It affects production schedules, labor targets, and facility expansions. When provincial borrowing pivots away from New York to Frankfurt, it reorders who gets a seat at the investment table. But not all gears turn smoothly. European financiers, increasingly driven by ESG mandates, may shy away from funding carbon-heavy initiatives. That could mean, well, new headaches for oil-aligned provinces like Alberta, or even for hybrid heavy vehicle programs that rely on legacy internal combustion components. Automakers may soon face a new reality. It's not just about finding the right workforce or tax zone anymore. It's about, finding the right lender. And in this reshuffled deck, your financier might be evaluating your emissions more than your profit margin. So, where does all this leave us? Let's wrap up with the big picture takeaway. Final verdict, a financial breakup with industrial fallout. Let's call it what it is. Canada didn't just skip Wall Street's table, it's setting its own. And while the headlines are about bond deals, the real story is unfolding far beneath, through logistics routes, public procurement policies, and strategic capital redirection. This isn't just a Canada-US spat, it's actually a prototype of how countries may respond when economic partnerships grow tense. By decoupling key systems, one contract at a time. So here's the verdict. This isn't a flash in the pan, it's a slow-burning shift that could reshape how and with whom North American industries operate. Before you go, Piston Pundit wants to know, with Canada moving its financial loyalties eastward, do you think this will impact what vehicles get built and where? Are we witnessing the early stages of a broader economic uncoupling between Canada and the US? Or is this just temporary political theater? Could this be the opening for other global players like China or the EU to gain leverage in North America's auto and energy sectors? Drop your thoughts in the comments. Whether you're wrenching in your garage or watching from a policy perch, we want to hear from you. Thanks for riding with us. You can now check out any of the videos on the screen. There's plenty more to explore.